Welcome back, traders. We have one of my favorite guys in the world, but I would never tell him that. Mr. Tim Melvin of the Tim Melvin Deep Value Investor Letters. He's also a world-renowned value investor, writes everywhere from Real Money at the Street to on our own site, Benzinga. Tim, good morning. I know you're not a morning person, so thanks for getting up early and joining us.
Oh, it's no problem. When you have a 10-year-old in the house that has to go to school, you become a morning person whether you wanted to or not.
Well, I know that Joel is more of the short-term guy, and I'm of the frame of thought, or at least my time and my day allows for more value investing. I wanted to talk before we got on the show this morning. You were talking about earnings and some value diversion, and I really wanted to get into a little bit of that. So, do you have some tickers offhand that you want to talk about?
No, not really. Not really tickers so much as we're going to step back a little bit of big picture here. I was reading some studies over the weekend as I was getting ready to spend good part of my week in the sunshine watching spring training baseball down here. And looking at the earnings as they come in, and we have an 8.3% earnings growth rate, which everybody says that's great, right? That sounds pretty good, year-over-year earnings growth. Here's the problem. There's only 0.8% revenue growth over the year. The biggest earnings growth sector right now is financials, up 25% year-over-year. Revenue's negative year-over-year. If you take that all the way out, and we go back and we look since the market bottom in 2008, you've got 118% earnings growth, which is spectacular. You have 7% revenue growth over the same period.
You said 118% earnings growth?
Yeah, right. Since the bottom in, 2009, 118% earnings have better than doubled. That's fantastic. However, revenue has only gone up 7%, which means that we didn't increase profits by selling more stuff to people or selling better stuff. We did it by laying people off and buying back stock. You look at that and you go, how long can this go on before companies, publicly traded companies, start making their money by selling more stuff?
Wow. So you're talking, so this isn't, how would you categorize that? Without revenue growth, that's not true growth. That's just cleaning up the company a little bit of maybe the books getting polished up or brownished up.
Yeah, for the most part, this is out and out financial engineering. They fired a bunch of people, and management's been buying back a lot of stock. Now, we all know how much money is on corporate balance sheets out there, but they're using it to buy back stock, which is, at 25 times earnings or 30 times earnings, or some of the levels that some of these guys are doing it at, is dubious at best. At some point, this money has to start getting spent on new products, new divisions, new projects that actually grow revenue, or we're going to hit a wall.
Wow, that's incredible. And so coincide that with you and I recently talked about the housing market and what we've seen with new home sales and new mortgages, and we're starting to see trouble in the housing market as well. We saw growth, but actually we talked about January, and we're looking really closely in February what's going on in the housing market to coincide with that.
Yeah, a lot of people want to say that the slowdown's been weather related. But guys, I live in Florida. Okay, a weather problem down here is a cloud in the winter months. We don't have bad weather. I was talking to a realtor friend of mine the other day, and he kind of hit it right on the head. He says, I just don't know where the jobs are going to come from to support all these new housing projects. We're overbuilding again. I think you're going to see housing again. Interest rates could very well bump up here a little bit. Job situation's dubious at best. For some reason, I'm using dubious a lot this morning. Must be the word of the day. So I think housing could slow down, and that's going to, again, be a drag on the overall economy. I don't usually talk big picture stuff. As you know, I'm very much a bottoms-up kind of guy. But I'm starting to see some stuff out there that worries me.
So we always talk about value, and we actually reviewed the Warren Buffett's value or best investors next door that you never heard about last week. And, we talked about where the spotting the opportunities. So are you looking for a correction here to re-enter into some stocks, or, to get that value back?
Looking for, praying for, I'd love to see a correction in the market, which is why I want to be careful, make sure I'm not just talking my book. But I will tell you, the value set right now is smaller than I've seen it in a long, long time. There are not a lot of safe and cheap stocks out there.
Are you talking even 2008, 2009, or I'm sorry, right before 2008, before the crash? There's just nothing out there.
We're talking exactly that. It's pretty interesting. And I will tweet a link out when we get off the air here. But both Tocqueville Asset Management and Farnham Street Investments have just done separate studies on value dispersion. And what they found is that the bottom 10% of all stocks in terms of price to earnings ratio, I would have used price to book, but they went with PE, look a lot like the top 90%. It's a very tight range. There's not a lot of stocks trading at those single digit PE ratios. They call it the fifth most dangerous statistical market of all time. I will say, coming back in and using price to book ratio, this looks a lot like 2007 or 1999.
All right, so are we looking for a catalyst then that's gonna pull us down?
You never know. Yeah, you're going to need a catalyst to get this asset allocation related buying, which is basically what we've seen the last 4 years, to roll over and go in the other direction. But again, from a bottoms up perspective, there's just not a lot of stuff to buy, and that does concern me.
Because the companies are buying back stock. You have a small IPO market, right? And with
right.
So people are competing, for stocks to invest in. But Tim, this has been going on for a long time here. The company's buying back the stock and raising the dividends. It just seems like it's going to go on forever. What now are you seeing? It's you're kind of saying, hey, it's finally run out here. What is there any indicators, or what are you looking at? I mean, because this has been going on for a couple years now.
It has been, but when they were doing it 2 years ago, they were doing it at 15 times earnings and 2 times book, and now they're doing it 25 times earnings and 3 times book in the larger corporations. And really, I am a bottoms up guy, but I only really use 1 or 2 big picture indicators. But the most reliable I stole from a guy you might have heard of, Warren Buffett.
I know what.
That's market cap to GDP ratio. And we're not as high as we were in 1999, but we're right on the edge of being as high as we were in 2007.
All right. Well, anyone that follows Tim knows that you're bullish and very concentrated on the housing, or not the housing, the banking sector. But something that you brought up to me the other day I thought was interesting was not gold, but gold miners. Can you discuss what you are looking at in that sector, Tim?
Yeah, it's the same thing I look at in every sector. As you know, even when I'm concerned about the market, if it passes the safe and cheap test, I'm going to make myself buy it, even if I'm concerned. And one of the things I like to do is track where private equity money is flowing and stocks are cheap. And late last year, you and I talked about it, we saw private equity firms suddenly starting mining operations. And the former president of Barrick Gold started a private equity fund to invest in the gold and silver miners. I have a preference for the silver miners. But these things got down to 50% of book value, and most of them are still trading 50 to 60% of book value, even after the little bounce that we've had so far this year. I know nothing about the gold and silver markets. If I buy gold, it's because I've done something wrong and I need to appease my wife, okay? But mining is a business like any other business, and these guys got down to the point where you could literally liquidate them for more than the value of the land and the machinery and the metal that they had on hand. So it was time to buy, and we did buy earlier this year. We're holding on to them, but I think they're still cheap enough.
And you got gold, as Joel and I were talking about earlier in the show, that's just had a nice tear through the beginning of the year, all the way up into highs today of gold was trading at. So you also have a nice strong price come back with the actual metal itself, which obviously helps the company.
Yeah, Tim, what do you think about this correlation here? Usually when the market has these slow rallies, you usually see people exiting the gold market here, but they've been moving together. Are you looking for this trend to continue here, or are we going to go back to the old days when the market rallies, they start hitting gold?
Tough to say. There's so much ETF and asset allocated relating buying going on there, and I'm not a technical guy. I don't follow that stuff that closely.
Okay.
But as money flows in, both could go in the same direction for a while. And by the way, that's a huge red flag. If you get bonds, gold, and stocks all going in the same direction for more than a few days at a time, one of the 3 of those is going to cave.
Okay, all right. I tend to agree with you on that. I really do. I mean, you got this type. I mean, you've had the the unrest in the Ukraine and Venezuela and some of those other companies here. So, all right, well, good. I'm glad you agree with me on that one.
And then lastly, Tim, my favorite topic is always the banking stocks. You have a newsletter called Banking on Profit on marketfy.com. Something that I follow really, really closely about this trade of the decade, as you call it, and you just came out with an ebook on it, discussing the makeup of our banking sector, why there's this little cap limit of assets that's caused a great trading idea. Can you discuss what your view is when you're looking at regional banks?
Well, here's the thing with the whole banking sector right now, and you've been seeing it a little bit in the earnings as they've come in over the last few weeks. There's the smaller bank stocks fell in conjunction with the larger bank stocks in 2008, 2009. They have not risen anywhere near as much as the larger stocks. There's no institutional interest in them. And as you know, until here very recently, this has been an entirely institutionally driven market. And those guys simply cannot be buying these $25 and $30 million banks that make up much of the portfolio. So here's your little banks. They're over-regulated now because they are subject to most of the same rules as the big banks. They're having to add staff just to keep up with the regulatories and the new regulations coming down seemingly almost every day from a different agency. These guys are tired. Their bottom line is being eaten into by regulatory costs, and they're kind of interested in maybe getting out of the business or selling or combining in a merger of equals in order to spread these costs. Here's the real problem for the regionals now. They can't grow organically. There's not enough mortgage or loan demand anywhere for a decent-sized bank like KeyCorp, symbol KEY, or Huntington Bank Corp, to grow organically. They're not going to be able to open a branch in another town over or expand their mortgage offerings and get earnings growth. They've only got one way to grow. That's to buy some of these smaller banks that are trading at 75, 80% of tangible book right now. And the sales price is going to be, it's starting now. The ratio is about 1.25 times book value. That's a huge, huge return. If you buy something at 80% of book, sell it, sometime in the next year for 125% of book, you've made a pretty handsome return in a year. This is going to go on for most of the next 10 years. And the ratio of price to book value is going to just continually go higher. Last time this happened, it topped out at around 2 times book as an average takeover premium.
This is one of my favorite plays based off of regulation, because when they imposed that asset limit, you had all these small banks that, like you said, sitting at 1 year, you could be sitting, very nice, 3 banks, very profitable, and the next thing you know, your assets cross that threshold. I think it's 10 billion, right? Right, Tim?
Yeah, 10 billion seems to be about the number where you're really viable as an institution going forward. And we've seen it already in the portfolio. Huntington Bankshares bought one of our banks not too long ago. These larger regionals are coming in and saying, all right, I want to be in this area. There's already a bank branch on every corner because although the number of banks has dropped, the number of branches has gone up over the last 20 years. So in order for me to grow and keep Wall Street and my shareholders happy, I got to buy somebody.
Do you have any symbols of any ones that are kind of on your radar now, some of these smaller banks?
I'll give you guys one.
Okay.
CZWI, smaller branch. There's an activist in this one big time too. Joe Stillwell's been buying the stock. He's pushing for this thing to get sold.
Now, explain the importance of that, Tim, the activist, because I didn't understand that when I was reading your strategy first time several months ago. But the activists are actually huge because they're the ones that, in the small banks, when there's not a lot of interest, the activists are the ones that can get it pushed and actually get it merged or bought by somebody.
Yeah, I mean, they'll buy as much stock as the law allows. I think that's 9.9% without a special agreement right now as an outside shareholder. And they'll come to management and say, look, we want our money. Your bank is worth more than it's trading for. You've either got to improve the bottom line, buy back stock, which now, again, buying back stock below book value is a wonderful thing. Above it, I'm a little skeptical. But you've got to do something to get our share price higher. Often the thing that gets done to get the share price higher is the bank gets sold.
Nice. So CZWI, a nice little play for everybody in here. And everyone in the chat, if there's questions you guys have, make sure to pipe them in. We'll always get them answered by our guests on the show.
Yeah.
Tim, awesome stuff. I really like, and I'm going to do some research into this earnings versus revenue growth through the rest of earnings season as well. I think that's a really, really important stat to follow for, I'd say, the rest of this year.
Yeah, if we don't start seeing some revenue growth, it's going to have problems both in the economy and in the market, I think. It's it's one thing to cut costs and increase productivity. And certainly we've seen a lot of that over the last 4 to 5 years, and that's a great thing. But we're not growing sales. That's a problem.
Sales growth. That is the word of the day for Tim Melvin. Tim, thanks a lot for joining us on the show today, man. I absolutely love your insights. We're going to be reviewing our next book together, The Shipping Man, coming up soon, looking at a really cool book Tim recommended in the shipping sector. So, Tim, as always, thanks a lot for getting up early and joining us on this 19-degree day here in Detroit.
Well, it's always a pleasure being on, and now let me go get some work done here in this 75-degree day down here in Central
Tim.
Florida.
All right. We're going to have to put some restrictions on you. Thanks a lot, Tim.
Bye, guys.